Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, Tuesday morning, and lots to track. Overnight action, I think, is positive, is constructive, like it was yesterday as well. Will we be able to sort of build on yesterday's session? Yesterday, of course, there was a bit of a pullback, but then the market moved up after that. So continued strength is the question as we begin this Tuesday morning. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, good morning.
Hi, morning. Welcome back, Prashant.
Yep, good to be back. I think Muhurat, right? Three of us were together, and now the full house is back. Overnight action, all good. I mean, markets, trade deals, everything happening, except one piece of news that kind of stayed with me: the layoffs. I mean, Amazon, almost 30,000 people are going to be perhaps losing their jobs. That's what reports are indicating. They're not done. The figure could go up to 500,000 over the next couple of months. So that's the reality of AI, but we have to deal with it.
Oh, that's right. That's a bit of a worrying aspect, but otherwise, markets are looking pretty okay for us. And today's the final day of the October series.
Everybody seems to be with the Trump administration. Everybody seems to be moving ahead.
This is dance in Malaysia.
Nothing for us so far.
Did you catch the dance in Malaysia?
Okay. Well, so a little constructive in terms of US-China trade talks. And this is, of course, yesterday's news. And I think the markets around Asia, etc., traded on the back of that. That it's kind of low on detail what eventually is going to happen. No, I mean, 100%, no 100%, rare earth maybe delayed, etc. But those were the two things which stood out to me. Otherwise, looks like, no further hostilities. That seems to be the broad directional view which markets are trading. So yesterday, markets around the region did very well. And I think, US traded last night, so you got a bit of that. So S&P 1.2%, fresh record highs. NASDAQ 1.8%. You had the Treasury Secretary in the US, Scott Bessent, saying that, we basically have a very successful framework for Trump and Xi to discuss this at their meeting on Thursday. Both deputies on both ends have met and discussed, and now there's something on the table for Trump and Xi when they sort of take this forward, meet face-to-face on Thursday. In terms of single stocks, there's always some bit about AI one way or the other. So Qualcomm was the story last night, 11% move, and they've sort of unveiled chips and computers for AI, the very lucrative AI data center market. And on the other side, as Surabhi also mentioned, you got this Amazon news flow, right? Now, we don't know how much of this is on the back of AI advancements and deployment of AI, which, reduces the need for people. But I'm assuming there is that bit as well. And by the way, this is corporate workforce. This is, I've not read the full story, but this is the other big story, which we will get more details on as we go along. Now, this week is important for a couple of reasons. So big tech earnings as we go forward. So Meta, Microsoft and Google will report numbers. So with regards to large, big mega cap tech companies in the US, it's a big one. Apple and Amazon will report on Thursday. So those are the two big dates, and big week for central banks as well. So you've got the Fed, which will sort of announce their decision. There's the ECB, and then there is the Bank of Japan as well, which will be announcing decision. For the Fed, is going to be, as always, Thursday morning. When we come back, we will have the Fed decision with us, which will be announced US Wednesday night. Consensus increasingly expecting that the Fed will end the quantitative tightening program this week. So we'll see if that comes to pass. Gold prices, right? I mean, had a one-way move and they fell another 3% last night. So under $4,000 is where gold prices are at this point in time. Now, just to time this and circle in the levels here. So nifty, the resistance is the recent high, just very, very immediate levels, 26,104. Yesterday, by the way, there was a bit of a shakeout, but then the market did not break very short-term moving average levels. Maybe that shakeout is complete, we'll see. But 26,104 is the first level. That's the recent high. 26,277 is the all-time high, which I guess we will have to wait for. And support is the swing low, recent swing low, which is 25,718. Bank Nifty, of course, also made a strong comeback after the prior session. And here, the immediate resistance is at the high of 58,577 and then 58,961. And support is at the low of 57,482. So those are levels. Overnight positive handover. And generally, macro markets, not very much. Yields, dollar, etc. I looked at, not very much has moved at all. So you got a 40-odd point bump at the word go. That's the indicative opening as far as GIFT Nifty is concerned. Nigel is now standing by with what the F&O positioning is looking like. Nigel, over to you.
Well, the October series has been a good one, and the bulls will look to end the October series on a high. Can they? Well, we'll know in today's trading session. But at the start of this series, we had made this point. Markets appear to be at extremes, and when we see extremes, we do see a bit of a bounce. And that's the way it's played out, right? Because the Nifty as well as the Nifty Bank, both of them have seen a very, very good series with gains of around 5.5% to around 6.5%. And the point we made on the extremes, the FI net short positions in percentage terms was at around 94%. That's the highest we've seen at the start of the series. That's come down to around 74%. So we've seen a massive short covering bounce, and the series has been a very, very good one. What about the flows? The FIs, the previous couple of series, they had turned aggressive sellers. Now, in this series, that's one of the big changing points, right? Because occasionally they were buyers and occasionally they were neutral, which is okay because the DIs continued to show the money. And yesterday's trading session, if you look at what they did in the F&O market or on index futures, well, there's some shorts are back into the system. So they almost added the equivalent amount of longs as well as shorts. Short positioning continues at around 74%. So not at extreme levels, but still it's a net short market. On the other two data points that we get in from the FIs, on stock futures, there is normally a strategy that takes place out there. And out there, you did see some shorts that did cover out. Even on the option side, they wrote more puts than calls in yesterday's trading session. In fact, the calls that were written, they were packing their bags because the markets ended closer to the high point of the day, unlike what we saw in the earlier two trading sessions. So good amount of put writing is what we saw. And we should get a couple of strikes up for you. Given that today is the monthly expiry that will play out, the 25,900 put, the 26,000 put, the premiums on both those two crashed closer around 50% in yesterday's trade. Which brings us to the levels. And all through this series, even on bad sessions, we have been making this point that this market seems to have got into a good rhythm and it had turned into a buy on dips market. So now, in fact, in the near term, the support level comes at around 25,800. That's going by the options data. And the swing high is going to be important both for the Nifty, that's up for you in the screen, and the Nifty Bank as well. On October 23rd, we had the swing high of around this 58,700 and 578. Support going by the options data is at around 57,500 odd. I'm going to be looking at two pockets in terms of stocks in news. One is the fall in gold prices. Muthoot will be a stock that's in focus. It's trading at 3 times price to book. It's had a good run. So keep an eye out on this because sometimes you have a sentiment impact on the stock. So this one will be one stock. And the other one is yesterday, the OMCs. They ended at the high point of the day, and there was a good amount of long build-up on all of them. Crude oil prices showing some weakness. Earnings are looking pretty okay. Some of these stocks are near their 52-week highs. So I'll continue to keep an eye out on all these three names.
Absolutely. And gold indeed was quite interesting because the profit taking did take gold, international gold prices, that is, down below $4,000 to the ounce. But now they've kind of recovered just around that handle once again. Let's pull up some of the Asian markets because there's a round of profit taking across Asia after a very strong start yesterday where markets were hitting historic levels in Japan and in South Korea. There's in general a sense of profit taking today. Most of the regional markets are down. Pull up the GIFT Nifty and the implied open. We had a consolidation day yesterday, but with a very clear positive bias. And the sense is that the bulls will want to build on that with that 37-point uptick at the open. So we'll deal with it as we get closer to market opening. For the time being, let's welcome in Richard Harris, Executive Director at Port Shelter Investment Management. Thanks very much, Richard, for joining in. So, the whole Asia tour, President Trump's Asia tour is catching all the headlines, and he's going around doing these trade deals and trade frameworks with all countries except India. I mean, at least the talks are still on, but there's no real headway. If indeed, the deal comes through with China, purely from an equity market sentiment perspective, could it drive FPIs further away from this market? Because we saw some glimpse of FPI buying about a week or 2 weeks back. That's again changed to a trickle now.
I don't think it's going to drive people away from the markets. If anything, it might actually lead to a further run in the bull market. I mean, what we're seeing really is Trump going around. He's negotiating with counterparties, but we've got precious little information from it. All we're getting is a series of declarations of victory from the US side. There's very little detail from the Chinese side, and relatively little detail elsewhere. I mean, he's meeting with Prime Minister Takaishi of Japan today. I've kind of feel that that's probably going to go quite well. You know, Trump is rather soft on iron ladies. It's the same with Giorgia Meloni in Italy. And I have a feeling he may actually get on well with the Japanese Prime Minister. So all the talk of the trade deal that was done between Japan and the US just a month or so ago, which was extremely onerous, I think will just fade into the ether. So it's very difficult to see what's real. It's very difficult to see what's not real. And there's ample opportunity for all sides to pull back later on. But I think in the very short term, it just has to be bullish for markets.
But that includes India, Richard? It's not disadvantage India?
Yes, I think so. I don't see why India should necessarily be penalized. And don't forget, we do have the opportunity in the future for India and the US to have yet more talks, because it is an extremely important trading relationship. Don't forget that many Indians, first and second generation Indians, are at the very highest levels of Silicon Valley. So I think this is going to be very much on their heart. So I would also hold out hope the same sort of thing is going to happen between India and the US. But at the moment, clearly, with a trip to East Asia, it's going to be a focus on those countries.
Richard, gold prices seeing a bit of a shakeout after that incredible run. Any prognosis here?
Yeah, it's not surprising that gold would have come back. It's come back below 4,000. It may actually start to find 4,000 is a little bit of a resistance level. But I think gold is interesting. Just around 2005, when the equity market started to move, gold started to move as well. And it powered through 2008 when equity markets came back. And it didn't really stop rising until around 2011, when confidence had come back into financial assets. So I do think gold is interesting to be in. I think certainly if we do see some sort of reversal in these markets, and by reversal, I mean something like a crash, because we are heading for that sort of territory. I mean, Jamie Dimon and Ray Dalio have been saying the same thing. We just don't know the timing. It could be 2 years out, but we are headed for some sort of reversal. And I think in that environment, investors will continue to accumulate gold. They'll continue to accumulate cash, just in fear of something quite serious happening a little bit further on.
All right. Hi, Richard. Good morning and good to see you in. What are you making of the mother market, which is the US market? You know, there are calls that maybe, in fact, that's getting into a bit of a bubble territory, particularly tech, AI. You know, some of those names out there. The NASDAQ is up more than 25% in a single year. But if I look at earnings coming out of the United States, and just looking at S&P 500 companies, the earnings growth of there is high single digit to double digit, which is very, very encouraging. What is your call with regard to the US markets, and also come in on this so-called tech bubble? Do you think it's reaching that territory, or do you think it has more legs?
Oh, I think we're deeply into that territory. If you look at some of the greats who've studied crashes in the past, it's things like high valuation, high debt, reduction of regulation, and a big story. Don't forget, in the dot-com bubble, we had the dot-com story. In 2008, we had the housing story. Now we've got the AI story, with companies basically lending to each other through the supply chain. NVIDIA's lending to OpenAI so that OpenAI will buy NVIDIA chips. And these companies can raise vast amounts of money. That money ends up in the stock market, either through earnings or through inflation of valuation. So, no, I think we're in the bubble already in the US. But, you know, bull markets die hard. It could be quite a time before we actually see it really come to a head. And then it may be due to some kind of unknown event that we just have no idea what it is likely to be at this moment in time.
But I guess caution would be well advised then at this point in time, if you're saying that the US market, at least with the AI stocks, is already in a bubble. We'll remember that, Richard. Thank you very much for joining in, and we look forward to more conversations again, a couple of weeks down the line. You have a good day.
Thank you. You too.
Thank you. Well, with that, let's tell you what else we've got lined up for you on the show. Plenty of interactions coming up at 8:35. We'll be in conversation with the management of Canada, HSBC Life Insurance, talk about their second quarter numbers. At 9 a.m., Prabal Sen of ICICI Securities joins in. IOC has reported numbers. And beyond those numbers, how are some of these refineries dealing with lower sourcing of Russian crude? What does that really mean for GRMs? We'll ask Prabal. At 9:20 a.m., Gautam Trivedi of Nepean Capital will join in. He's our market master of the day. At 9:30 a.m., the management of Bata speaks with us. It's been a rough quarter for Bata, so we'll find out what the next steps look like for the company. After that, we have Anshuman Singhania of JK Tyre and Industries joining in, talk about their Q2 performance. And at 9:50, we have Harshit Kaparia of Elara. He tracks the capital goods space, and we discuss the expectations from the sector ahead of Q2 numbers. Towards the end of the show, in our special segment, It's the Economy, Lata will be in conversation with Samiran Chakrabarti of City India and Harish Damodaran of the Indian Express on the strength of rural demand after the Kharif season that has just ended.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We'll get to that in just a bit. For the time being, giving you a sneak peek. IOC, Indus Stars, Marscount Dock, PNB Housing Finance, Sona BLW Precision, JK Tyre, AB Capital, and K FinTech. On the flip side, we have Bata India as well as HOEC that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names. Welcome back. You're tuned in to Bazaar Morning Call. The last promise, our research team is standing by with all the top stocks you need to track. And let's start off with Sonal, who's here to tell us about IOC's numbers. Hey, Sonal, morning.
Good morning, Nigel. Well, it was a strong set reported by IOCL, a top-down beat led by improvement in their refining segment. So if you look at the numbers versus the poll, revenues higher, EBITDA at 14,583 crore rupees, margins have come in at 8.2% versus a poll of 7.4%, and profits also higher at 7,610 crore rupees. Their gross refining margins higher than the poll at $10.7 per barrel. And if you look at the trend as well, this is the highest level that we've seen in last 7 quarters. So refining outlook is definitely improving. Jeffrey says even their marketing margins on diesel and petrol came in higher on a quarter-on-quarter basis at 7.4 rupees and 11.6 rupees respectively. But now margins have declined in quarter 3. But there's still room for strong margins, even if there is some excise duty hike that could come by. However, they say the outlook on refining has now weakened because sanctions on Russia will lower availability of advantageous crude. However, the numbers were strong, and that's why going with green on this one.
All right, Sonal, thanks very much for that. Let's move on. Indus Tower went up yesterday after that Supreme Court relief for Vodafone Idea. But there's more. Rima is here with details. Rima, morning.
Hi, morning. So there are two positives in Indus Tower's numbers. One, the EBITDA margins were a beat. EBITDA margins expanded by 180 basis points sequentially to 56.3%. One of the key drivers for that is that the company has been writing back provisions that it made for Vodafone Idea. Vodafone Idea has been making its monthly dues, and in the current quarter, the company wrote back a provision of 195 crore, which is higher than the 88 crore provision that they've written back in Q1. But even if you strip that out, analysts point out that margins look good. So that's reason number one. The second one is the tower acceleration in Q2. So in Q2, the company added about 4,300 towers, an expansion versus the 2,500 that they added in Q1. Other numbers largely okay. Revenue growth 1.6% sequentially, and a profit jump of 5.9% quarter-on-quarter.
Okay, and the stock did well yesterday as well after the Vodafone verdict came out of the court. We'll see how it does today. Rima, thank you very much for that. Let's move on then. Defense majors also in the limelight. Marscount Dock has reported numbers. Upasana, morning. How do the numbers look?
Good morning, Sir B. Well, overall, if we see, the numbers are quite steady this quarter with robust margins. Now, revenue grew by 6% on a YoY basis. This is likely due to a slower execution this time around, while EBITDA margins have seen an uptick of 520 basis points. This is likely due to delivery of P-17 stealth frigates and even the provision reversal which has happened this quarter. Now, we look at the order book of the company. It stands at 27,400 crores. And now coming to the guidance for full year, the company has given a revenue growth guidance of 8 to 10% with a EBITDA margin guidance of 18%. And the company, if you look at the H1 figures, they are well within the guided range. The revenue growth for H1 FY26 is around 8.6% and margins also stand healthy at around 18%. Now, Phillip Capital says that the revenue growth could improve once the additional order of P-75 submarine is under execution, that is FY28 onwards. Now, coming to the numbers, the revenue saw an uptick of 6% as mentioned earlier. EBITDA saw a growth of 36% on a YoY basis. Margin stood at 23.7 versus 18.5 and PAT stood at 749 crore with an uptick of 28%. So overall, if you look at the numbers, they look quite steady this time around.
All right. Upasa, thanks very much for that. PNB Housing Finance financials now have been, of course, all the talk of the town with lots of deals, but this one with Gaurav. Gaurav, morning.
Well, yes, when we look at PNB Housing, I'm going with green today. And the reason being that when we look at profit, we saw a strong growth. So let me take you through the numbers. Net interest income that increased almost by 14% on a year-on-year basis. Now, in this quarter, we saw some pressure was there on the yields, and I'll come to that. Apart from that, when we talk about PPOP, which is pre-provisional operating profit, we saw around 16% growth in line with the street's expectation. Now, provisions that were negative once again at around 116 crores. And that is the reason why when we look at profit, that increased almost by 24% on a year-on-year basis. Now, coming to the ratios, when we look at net interest margin, we saw a bit of a decline of around 7 basis points. It is something which is quite negative because it was not something that the street is expecting, but at the same time, it is in line with the guidance. Apart from that, when we look at the loan book growth, that was at around 16%, and this is driven specifically by the emerging market and the affordable segment, as always indicated by the company that they want to focus on these segments. Apart from that, when it comes to guidance, they are guiding for loan growth of around 17 to 18%, so management is almost there. Apart from that, net interest margin guidance of around 3.6 to 3.7%. Credit cost, they say that it is likely to be negative in FY26. And another hiccup in this result is that today is the last day of Mr. Kosgi as MD and CEO, and there is still uncertainty, and management did not call or indicate what is the roadmap going ahead in terms of the leadership. So that is something that could be a hiccup, but in terms of number, good set of number delivered by PNB Housing in this quarter.
Okay, all right, got that. Thank you very much, Gaurav, for the details there. Let's hop across to Sudarshan now. He's looking out for numbers from Sona BLW as well as JK Tyres. Good morning.
Morning, Surabhi. So first talking about Sona BLW, as far as numbers are concerned, the numbers are looking much better than estimates. While all the headline numbers, you talk about profit, revenue and EBITDA, everything has seen a double-digit growth, while margin has seen a fall of almost 200 basis points because of adverse operating leverage and product mix. Now, BEV revenue also has fallen by 17% to 265 crore. But apart from the earning, there is a separate announcement. If you remember, in July of 2025, company had announced that it would form a JV with a Chinese company that is called Genet Machinery. And there was an expectation that client for the JV would be BYD. Now, the fresh announcement that company has made is that JV announcement that it had made has been put in the abeyance. So that might be taken negatively, but I'm going with mild green just on the basis of the earnings, but we have to be cautious. Second, the stock is JK Tyre. It has announced earnings that is looking very healthy. All the numbers here also have seen a double-digit growth. Margin also has seen an improvement of more than 200 basis points, and revenue was largely led by healthy volume growth that company has seen in both for India and Mexico business, where India business volume has grown by 15%. In Mexico, the volumes have increased by almost 13%.
Okay, all right. In fact, we'll have the management of JK Tyre and Industries who will be joining in at 9:40 a.m. to decode the past quarter's numbers and how do you see the quarters ahead. That said, let's hop across to Mangalam. He's here to tell us about Bata India. Morning, Mangalam.
Good morning. So, it was a GST-related quarter, so there was disruption on account of that. And at the same time, there was a disruption at one of their major warehouses in the month of July as well. All of this impacted Bata's performance. In fact, the company went ahead and looked to liquidate some of their inventory. To add to all of that, we had a VRS expense as well. So you put all those things into perspective, the revenues were down 4%, the EBITDA was down 17%, and the net profit actually saw a decline of 73%. There was deferment of purchases. The company said they saw signs of recovery in the festive season. EBITDA was lower due to inventory clearance and higher marketing spends, but premium products are showing robust growth. Expect the stock to open in the red, but may see a bit of recovery because for Bata, even the last quarter I had said, it's like that shoe in your cabinet which you don't wear, but you don't want to discard because you believe that at some point you will wear it.
I have plenty of those in mind. Oh, that touches a raw nerve, Manglam. Thanks for that. Well, Gunjan Shah of Bata India is going to be joining in to talk about how they're looking at the second half once the GST normalization actually happens. So that's a conversation coming up at 9:30 a.m. All right, with that, let's head back to Sudarshan. We're anticipating a block deal in AB Capital, right, sir?
That's correct. So we might see a clean out trade in which block deal might happen for 2% equity, in which Jomi Investments is likely to sell its entire stake worth $184 million. And the price is 304.55 per share, which is a discount up to 2% to the current market price. But I'm going with GIN for two reasons. First, that it's a clean out trade. Second, it might happen in the block deal window.
Okay, all right. Got that. Thanks, Sudarshan. Let's quickly get back to Sonal. She's watching out for some more numbers, I think, from KFinTech and HOEC. Sonal?
Well, for KFinTech, it's numbers. There's a news update on HOAC, but let me start with KFinTech. It was a strong set this time around. Revenues are up 13% at 309 crore rupees. This was driven by growth in issuer solutions and international business. Their EBITDA was up 19%. The EBITDA expansion was around 234 basis points on a YOY basis. Their profits were also up 21%, so expecting a green there. For HOEC, it's a negative update because they supplied crude oil to HPCL, to which HPCL replied saying that the quality was not good. It had excessive salts causing corrosion and low output, because of which operations were impacted. And HPCL has now asked for damages on this supply. So HOEC will be in focus on the back of that.
Okay, all right. Thanks a lot for that. So now let's do a quick recap of all the top stocks we just discussed. A lot of ones with positive news flow. So let's run you through the list. IOC, Indus Stars, Marscon Dock, PNB Housing Finance, Sona, BLW Precision, JK Tyre, AB Capital, and KFinTech. While a couple of them will be reacting to negative news flow, Bata India and HOEC. Well, that said, let's turn our attention away from the equity markets to the commodity space. Manisha Gupta joins us to tell us what went on overnight. Well, Manisha, good morning. After a while, I'm going to be hearing you say gold prices have dipped. Maybe it could be temporary, though. Tell us more.
Oh, well, yes, absolutely, Nigel. I mean, it's a second straight week where you have seen profit-taking or a sell-off continue in case of golden prices. It was long due coming because the kind of run-up that we had seen, it was overheated. It didn't seem sustainable beyond a point. And then you finally have this. Interestingly, you have the gold prices now trading below $4,000 an ounce. So after hitting a 43.80 of an all-time high, we've seen a considerable profit-taking come in here. So when you look at gold and silver both, we're looking at a 3-week lows for both of these commodities. What also has gone into profit-taking has been the crude oil prices. Well, last week was one of the best in many, many months. But when you look at the Asian markets right now, and this is coming in after OPEC saying that they may increase production if the Russian sanctions lead to supply disruptions in the global markets. So there you have it. There is excess supplies anyways. And if OPEC continues to increase production, given the fact that the demand isn't gaining as much, you could be looking at further decline for the crude oil prices. But what has been doing quite well has been the metal prices. While copper prices did see a sharp decline overnight, it is aluminum which is still looking at a new 3-year lows at this point in time. While tight supplies, bullish longer-term demand seems to be supporting.
All right, Manisha, thank you very much for that. So commodities in focus there. We're going to come back in just a bit from now. Parag Thakur of Fort Capital with some fundamental stock calls. We'll put some of the earnings reactions to Parag as well. Ask him what to do about a few of these names. Stay tuned. Coming up.
Welcome back. You're tuned into Bazaar Morning Call. Well, as promised, let's get in Parag Thakur, Senior Fund Manager at Fort Capital, who joins us on the show. Hi, Parag. Good morning. Good to see you. Parag, Parag, I just want to ask you first about all these banking deals that we have seen in the last, 20 days or so. We had that RBL Bank, we have Sammaan Capital, from the financial space, and also you had Federal Bank, the recent one being Federal Bank. What's your view on these companies and which one would you be most bullish on?
So I am most bullish on Federal Bank. There is no doubt. Of course, I appreciate that all foreign investors and even strategic investors like Emirates are looking at Indian financials very closely because they offer you double-digit growth, and right now asset quality is not a problem at all. Even in the unsecured part of the books, the problem has stopped worsening further. And just to tell you further on Federal Bank, I'll give full marks to Mr. Manian. Of course, the bank already had a very good legacy, 95-year-old legacy, and it is a very conservative and prudent bank from beginning. They have very low exposure to unsecured and risky assets. But after Mr. Manian has come, the ROA and NIM journey has begun in spite of repo rate cuts, which is actually obstacle in increasing margins and ROAs. But in Q2 itself, 15 bips QOQ margin improvement, led by three main factors. One is improvement in CASA QOQ, which is very, very rare right now in banks to improve CASA, right? The second point is increase in lending to mid-yielding assets like gold loans or construction equipment, tractors, commercial vehicles, and business banking. And third is, of course, fee income. So NII and fee income for Federal Bank were at all-time high. Fee was 1% of total assets, which was all-time high, and NII was around 2,490 crores, which was all-time high. And now Blackstone is coming in to buy 9.9% stake at 6,200 crores. So this will give them capital also. Of course, they are very comfortable in terms of capital at around 15.7% tier 1. So I would say that Mr. Manian has started doing all things which I expected in terms of to improve their ROAs. Because the Federal Bank always had a low ROA. That is a problem because it was a very conservative bank. Now, if they land to mid-yielding segments, at the same time they take steps to improve CASA, which they are already doing, I think it is headed for 1.4% ROA in FY28. And that is why I feel that stock should go to 300, 320 in next 1 year. And it is for the first time, I would accept that this is a stock which I am adding even at 52-week highs. For the first time in my life, I am doing this.
A point taken. Sometimes it just takes years, right? I remember many years ago, a lot of the top people at HDFC Bank had moved to Federal Bank, and there was a lot of excitement. This is about maybe 10 years back that it's going to, and a great deal of excitement, but never went anywhere. So this is like the second coming in that sense, where.
See, I'll tell you, the bank which does not already inherit any problems in terms of asset quality, when it gets a leader like Mr. Manian, who was in Kotak for 25 years, it's actually after the repo rate cut cycle is over, say by December, where I am expecting another rate cut in December. And that is the worst thing which will happen for banks. After that, I think next year is looking extremely good for all banks.
Absolutely. But it's all I'm saying is never one thing, right? It's a confluence of things which come together, which kind of, it all has to fall into place. And sometimes it does, as I think it is now for Federal Bank. Parag, gold prices, right? So gold was going up and all these gold finances were going up. Now gold's falling a little bit after this astounding run. What's your sense for gold finances?
So see, in my view, as I told you, I never chase momentum, and that is why I accepted that for the Federal Bank first time. But still, I feel that there is enough room if you give it a time, 2 to 3 years. And of course, by the way, gold loan is 13% of the loan book for Federal Bank also. But I would say that if the US signs trade deal with important trade partners like China and India. And if there is no further worsening of geopolitical situation in Russia and Ukraine, I think then the gold is headed downwards. But of course, the first part of the puzzle seems to be getting solved, which is trade negotiations, which are going in a positive direction, at least right now. The second part, I am not sure about Russia-Ukraine. And so that is why I would say that 3,800 in my view in gold looks likely. After that, we'll have to see how geopolitical situation pans out.
Okay. All right, Parag, just stay on. We'll have more questions for you. Want to discuss more stocks, but we also need to get to a couple of important earnings calls. Now, Canada HSBC Life Insurance is the first management that we're speaking to on the show today. The company reported a steady set of numbers for the second quarter. To talk about this, we have Anuj Mathur, MD and CEO at Canara HSBC Life Insurance, joining in. Mr. Mathur, thanks so much for being with us, and season's greetings to you. Hope you had a good festive season.
Thanks for giving me this opportunity, and good morning to all of you.
Thank you. Thank you. So the numbers that I have in front of me, I mean, total APE growth at about 11%, VNB growth of about 21% year on year, and the VNB margin has shown improvement at about 19.6 versus 18.9. Can you just walk us through some of the factors that drove the performance in this quarter, and more importantly, with the GST total exemption on life insurance, health insurance, life for you to zero, what does that mean in terms of the P&L from here on? Because there's that issue of the input tax credit, right?
Right. Yeah. No, sure. So I'll explain each of these things. So first of all, we had very good set of numbers for the H1. Very happy to report that our individual WPI, so this is the weighted premium income, which we monitor, industry also looks at it. We have seen 14% growth in WPI in H1 of this year versus last year. Compared to industry growth, and I'm talking of private sector average of about 8%. So we have outperformed the industry growth. In terms of VNB margins, they have improved versus last year. We have finished H1 with 19.6% versus 18.1 last year. So there's a improvement of 150 basis points or 1.5% in terms of VNB margin. Our PAT has grown by 16%. So across parameters, we have seen good growth. Not just that, our market share also has improved by 0.2% over this period. So very happy with the set of numbers. Our ROEV, return on embedded value, that is in the range of about 18%. So all these parameters are kind of very, very strong.
Mr. Mathur, sir, if I could just understand, because we don't have the specific numbers for Q2 per se. So maybe on some of the major numbers, maybe on the VNB margin, for instance, as of Q2, where is the margin?
So our margin has improved. I don't have exactly quarter-on-quarter movement because this is the first time we are presenting our numbers after listing. So numbers are positive. So our VNB growth also is positive in Q2 versus Q1. Similarly, in terms of AP also it is positive. And maybe going forward, we can share quarter-on-quarter movement also. But because this was the first time after listing, we thought we'll present the first half results.
Okay, and maybe from the next quarter, we'll have quarterly numbers to compare as well. Mr. Mathur, good morning. Good to speak with you. Prashant here.
Hi, Prashant.
Could you talk to us a little bit about, the full year numbers? Where do you see yourself ending the full year on APE and VNB? I think in H1, as you said, AP is up by 11%, VNB about 21%. H2 is generally stronger. So for the full year, what can we see?
You're right. As I mentioned, our WPI growth has been around 14% higher than the industry. For H2 also, we have similar guidance wherein our growth in terms of WPI will be in the range of 18 to 19%. That's our expectation on the top line. Our VNB is going to be very steady. In fact, despite short-term impact of GST, we expect our impact on VNB will be very minuscule. And we'll be able to maintain this margin of about 19% or so. And coming to the GST question, in terms of how it is going to impact us in short term and as well as long term, we have taken a number of measures to kind of reduce the impact on the VNB margin. Focus on protection is clearly there. Our credit life business has grown by over 40% during first half. We are focusing a lot on the term business. We see our term business going up, which will help us in terms of VNB margin. We have taken certain steps in terms of sustainable saves also, cost rationalization. So with all these things, we expect our VNB margin to be steady in line with what we have delivered in H1.
Okay. All right. Hi, Mr. Mathur. Good to speak to you on the show. This is Nigel on this side. A quick question with regard to ULIP. ULIP is high. I think it's around 50% of the APM. That's as of the first half of the year. To what point do you want to bring it down to? And if you could give us a sense, what would an ideal product mix for you look like?
Right. No, it's a good question. In fact, last year, around same time, our UL mix was 53%. So we have seen decrease in terms of the ULIP contribution. We expect this, but let me also share with you that there is a genuine customer demand which is coming for ULIPs. So we expect that our ULIP contribution would be in the range of about 45 to 50% as we close the year, which I think is a fair balance. In fact, we have taken few steps to actually optimize our VNB margin with this kind of ULIP mix. As I mentioned, we have gone ahead with riders attachment, which is helping in VNB optimization. We have actually moved our protection mix also in terms of credit life. So all these measures are going to help us in further improving the VNB margin.
Okay, all right. If I look at your embedded value grew by close to around what? Around 16-17% in the first half of the year. Do you think for the next few years it can grow by high teens, maybe a 15 to 20% range? Is that possible?
Yeah, that's the broad expectation. In fact, if you see, we are a consistent performer in terms of whether it is top line, VNB or EV. So we expect our ROEV also, our embedded value to grow in the range of about 17 to 18% consistently.
Got that. Mr. Mathur, what is the share of, what is the non-banker share for you in terms of sales channel?
So currently it's about 15%. And we have, in fact, recently launched agency channel also. We are going to grow our agency channel, which will help us to diversify. And this bank insurance share, which is currently about 85%, is likely to go down.
Okay. On that 15%, are there, as we understand it, there are some negotiations which are going on with regards to how to pass on this GST cut, how to go about it. Are they still ongoing?
So see, one thing which I'd like to mention about is that we are a very, very efficient company. We are a lean company. Our cost ratios are actually best in the industry. We would be in top 3 in terms of our cost ratios. So the impact on our company on account of GST is not much. We see GST as a positive enabler for the business. We expect volumes to go up. So we don't think so that we may have to resort to kind of cutting down the commission levels from where they are currently or reducing the GST on the new business, which we do with our bank partners. In open market, yes, we will adjust GST from commission in line with the market. But otherwise, our cost ratios, our commission rates in the banker channel are quite efficient, quite normal. And I don't think so there's a need for us to immediately cut or adjust GST from there.
You mean on the banker side, no, but on the market, non-banker, you will adjust accordingly?
That's right, yeah.
Okay, and that has not been decided. Those are still negotiations on with, or that is set?
No, we have already communicated to some of our distributors in the market.
Okay.
And the process is on.
All right. Mr. Mathur, we'll leave it there. Thank you very much for joining us. Good speaking with you and appreciate it very much here on CNBC-TV18. Good luck and look forward to our next conversation. Well, a quick note for our viewers. As you can see on the screen, there's a money control stock score just above the line graph. Now, this is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameter considered for calculation of the 4 factors are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor / viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor regarding investment decisions. Okay, we'll take a break here. Up next, Sudarshan Sukhani, Mitesh Thakkar with us with some technical trading ideas. Stay tuned. Okay, welcome back. You're with us here on Bazaar Morning Call. There's 12 minutes to go for the pre-open session to kick off. Hormuz is here with the big movers from yesterday, which saw heavy volume action. So just sort of what lay behind the price action. Hormuz, take it away.
Morning, Prashant. And the most talked about stock in yesterday's session undoubtedly was Vodafone Idea. After all the developments that happened at the Supreme Court, it saw a very volatile trading session after that. The stock at one point was up almost 10%, eventually came off those levels, eventually closing just around 3.5% higher. We'll take a look at the volumes though, and it was 323 crore shares of Vodafone Idea that were traded in yesterday's trading session. The 20-day average average is just under 85 crores, so 4x of its 20-day average volumes in yesterday's trade. And out of those 323 crore shares, just around about 45 crore shares were marked for delivery. The 20-day average is just around 18.5 lakh shares. Interestingly, yesterday's delivery volume, which was close to 45 lakh shares, was the highest in well over a month for Vodafone Idea. Now, Firstsource Solutions mid-cap IT was buzzing in yesterday's session, more on the lines of anticipations of a rate cut from the Fed on Wednesday night. And Firstsource was up 8%, the biggest single-day gain since March. The volumes were also the highest since January of this year. We had close to 2 crore shares that were traded on Firstsource Solutions yesterday. The 20-day average is around 11.5 lakh shares. But out of those 2 crore shares, only 25 lakh were marked for delivery. And the 20-day average here is close to 6 lakh shares, so 4x of its average delivery volume as well for Firstsource. PSP Projects was one other mover yesterday in the broader markets. No specific news trigger behind it, but the stock was up 17%. The biggest single-day gain since its listing. The stock is up in 4 out of the last 5 sessions. The volumes were the highest since July, but the volumes on Monday were the sum total of the last 56 sessions put together for PSP Projects. 94 lakh shares were traded. The 20-day average is just a lakh. And out of those 94 lakh shares, 9 lakh shares were marked for delivery. The 20-day average here is less than 60,000 shares for PSP Projects. And lastly, RR Kabel, that stock was up and about in yesterday's trade, the third best performer on the Nifty 500 yesterday. The volumes were the highest since April. Yesterday's volumes were also the combined volumes of the last 26 sessions for RR Kabel. Close to 33 lakh shares traded. The 20-day average is less than a lakh for RR Kabel. And out of those 33 lakh shares, 3 lakh shares were marked for delivery. The 20-day average just over 60,000 shares. The stock also remains in focus because it reports earnings this week.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's go back to Parag Thakkar. Parag, what's your view on the big boy Reliance Industries? You know, that's suddenly finding its form. There are a few triggers in place as well. A potential listing of Jio as well could be in the offing. And the business on the whole seems to be coming together. I think in the month of October, actually, it's been one of those outperformers. Your view on the stock?
Yeah, definitely. So it is one of our largest holdings in the portfolio, just to put a disclaimer. And we are very constructive ways. See, in near term, I would say refining margins have improved significantly last 1 week itself. That is a big positive. Jio continues to do well. We have seen the subscriber addition numbers, which are anywhere between 30-35 lakh subscribers every month, which is phenomenal. Plus, I would say the retail part delivered very well, 16% revenue growth and EBITDA growth in Q2, and that is likely to continue in Q3 because of festive. So I would say that all stars are aligning for Reliance, as you said, except for Petchem, in my view. Plus, you have a media business which is doing very well, Jio Hotstar and other media properties. Plus, you have a new energy business which will start coming in next year. So I would say that at current market cap of 20 lakh crores, you are getting media business, new energy business absolutely free, and half of O2C business is also actually free in my calculation. So I would say that anybody can expect 1700 or so. If this kind of traction continues on retail side at least, which is more sustainable, refining is of course very volatile and cyclical. But I would say that if refining and retail continues to fire, I don't see any negative for Reliance. And I would say another 15% move looks very likely in Reliance if refining and retail continues its momentum.
I have two sets of questions, Parag. One is Vodafone Idea and Indus. If you have any thoughts from here, from a stock perspective. And second, did you see the government has cleared, this projects which are approved for electronic components manufacturing scheme. So Keynes and Syrma, Amber, etc. Many of these were kind of known. The amounts perhaps a little different. I think for Keynes it's higher, substantially higher than what markets assumed. If you have any thoughts here on these three on the back of the on the latest scheme.
So I would like to say that, see, on Vodafone, my assumption is that it is the ball is in government's court now, in my view. So I think there will be some relief and some material relief. The company operations ongoing, and that will help Indus Tower also. Of course, Indus Tower's dues from Vodafone has reduced materially, and they are coming on time, which is great news. And we have Indus Tower, by the way, in our portfolios. And I would say that I have bought it with the logic that see, Bharti is also continuously increasing stake in Indus Tower, which is a very good indication to start with. On 1 lakh crore market cap, I think the cash profit is above 15,000 crore, which gives you 15% cash flow yield. And now that Vodafone situation is only getting better, I think Indus should do well. Plus, they are expanding into Africa for growth. And I think once Vodafone situation stabilizes, the Indus Tower management has said that they'll restore the dividend payout also. So I would expect a good dividend payout next year once the Vodafone situation stabilizes. So I would say that I'm positive, and I will continue to be very positive on Indus Towers.
All right, Parag, I wanted to ask you about the appliances space. Whirlpool, actually, the global company, came out with its set of numbers overnight, and the commentary on the India business said, yes, they're looking at bringing down stake from 50% to around 20%, but they also mentioned that most of the technical agreements for this is in place, with regard to the sell down of this particular stake, and they have mentioned strategic agreements are in place. The stock trades at a discount because of this overhang. From the space, I believe you still like LG, and a word on Whirlpool, if at all?
So Whirlpool, because of this overhang, we have not looked at it very seriously. Now, of course, we'll have a look. But LG Electronics we own, and we continue to like the stock. Even if you see Vijay Sen's commentary, they have said that upgrade to LED TV has been a big theme of this GST cut, at least for consumer durable segment. And LG is a fantastic play on LED TV. They have a very significant market share over there. Plus, I would say that it's a company with above 60% ROIC and leadership in all the underpenetrated categories. So I would like to believe that LG offers a fantastic opportunity to play consumer durable and the underpenetration of that particular category in a very high ROC way.
Got that, Parag. We'll pick up on that Keynes Sirma question later. We're out of time. Thank you very much for joining us, and appreciate it very much here on CNBC-TV18. We'll take a quick commercial break here. We are back with the pre-open rates. Prabal Sen of ICICI Securities will be with us. IOC reported second quarter earnings. We'll also tell you that lots of oil companies which are reporting are also, putting out the amount of oil that they're buying, Russian oil that they're buying, and it's all pointing to a steady decline of Russian oil purchases as a share of the total. So coming up in just a bit.
Welcome back. Well, we'll have a whole bunch of stocks that'll be reacting to their earnings, and we'll start getting the pre-open rates in the next couple of seconds. Let's actually go across to our technical experts ahead of that to understand today's trading setup. Sudarshan Sukhani and Mitesh Thakkar are with us. Gentlemen, morning as always. Sudarshan, what's the approach at the index level? What would you be doing today?
Yeah, good morning. Well, yesterday we went long, took advantage of that quick correction, and that trend continues. World markets are doing much better than us. So I would suggest that we should probably see a steady uptrend, but maybe not outperform. Still, so far as the trend is up, be a buyer, buy on a small dip, buy on a small consolidation to protect these long positions. Just keep your tight stops somewhere around 25,800. With that stop loss, stay long and be in the market on the long side.
Okay. So buy the dip and stay on the long side. That's Sudarshan's advice. What about you, Mitesh? Morning.
Good morning. So again, I maintain a positive stance saying that we'll hit the all-time highs, maybe even cross them. But till that happens, there could be some amount of profit booking. And I would agree with Sudarshan. I think buy the declines. Broadly, it's a market which is biased on the upside. But till it clears 26, 150, 220 zones, you could see, profit booking around those levels. So the idea is that try to take profits as we get close to about 26,200. And if you get a decline back to 25,800, wonderful buying opportunity.
Okay. Let's talk stocks as well. By the way, the pre-open session has opened out, but yeah, not really worth looking at. The rates are really all over. The Nifty right now 300 points lower. Let's just wait for it to settle down. Let's talk stocks in the meantime. Mitesh, what's on your list?
I have more of buy calls today. CDSL completed a multi-day pullback and gave a reversal yesterday on the upside. So buy here with a stop at 16.15 for targets of around 16.75.80. CAMS had some kind of a breakout pattern yesterday. So buy here with a stop below 39.19, 39.20 for targets of 40.50. Also buy on ABB, which is trying to give a reversal from the lower side, some positive crossovers. So buy with a stop below 5,200 for targets of 53.20. And one sell call, that's Excite. Keep a stop at about 386.5. Try to sell in the range of 380 to about 382 and look for a target of around 370.
Okay, got it. Thanks, Mitesh, for that. Sudarshan, coming across to you. What about your picks?
Well, it's all on the long side. AB Capital is a buy with a stop under 305. Bharat Forge is a buying opportunity, stop under 1280. And all PSU banks have very good charts. So Canara Bank here is a buy with a stop under 127. And Siemens, which comes again in my list, is a buying opportunity with a stop under 3100. This is a market, and just a question to Prashant. He's the geopolitical expert. I have a sense that India is likely to underperform because we are not in that same comfortable position as China or Japan is. Is that correct?
Prashant?
It's a question for you. Yeah.
No, I'm hardly the geopolitical expert, Sudarshan. But no, I just, with regards to oil, Sudarshan, right?
Generally, with regards to the stock market.
Yeah, I mean, I just hope, we also get something done. And I was just actually, Sudarshan, before we came to both of you, we were discussing this in the studio, that maybe, it's there are local elections around the corner, right? The Bihar elections. So maybe, it's just thinking out aloud, maybe is that the reason why, we are, because, it's going to be give and take. So, will we wait for the elections to be over and concede if something needs to be conceded and get that deal with the US? I think that's essentially what we were just talking about. I mean, as I said, it's not some specific information or anything, but I was thinking aloud that by maybe November or something, hopefully, Surabhi, we get something done.
That's exactly what we were just discussing right now. So, Darshan, Mitesh, look at crude, for instance, right? Now, the biggest sticky point right now is whether India will stop buying Russian oil or not. The US president has proclaimed that he has been assured by the Indian side that we'll stop buying Russian oil by the time this year ends. There is no official confirmation to that effect from India. But if you go by the commentary that companies are giving out, refining companies, then in their crude mix, the amount of Russian crude has been declining. In fact, gentlemen, thanks so much. We'll come back to you closer to market opening and we'll maybe discuss some of these stocks. But that's exactly what we're focusing on now. The reduction, or let's say the reduced participation of Russian oil in the overall mix so far. We had IOC reporting numbers yesterday as well. Chennai Petro has reported. Let's get some of the highlights out of the way first with Sonal, and then we'll discuss this with Prabal Sen. Sonal?
Both these companies, all the three refiners so far have reported strong set of numbers, but the commentary was more important. For instance, IOCL did indicate that they will comply with US sanctions on Russian crude oil. They will be in touch with the government as well. The Russian crude intake declined on a quarter-on-quarter basis to 19% versus 24% on a sequential basis. And they are flexible to source from US or any other sources as well, whatever is efficient in terms of the cost for them overall. Reliance Industries said they'll comply fully with guidance from the government with respect to Russian oil imports and sanctions from the UK and the US. We spoke to Chennai Petro as well yesterday. They said the sourcing was as high as 40% earlier. It has come down to 20%. They have expanded the source of oil sourcing that they are doing. They are also started sourcing more from the US in terms of crude oil. Now, do remember when we started, as a country, started importing Russian crude oil, the discount was $15 to $16 a barrel, and now it has reduced to a single digit, around $3 to $4 per barrel. So that discount has massively reduced as well. Jefferies today in its note did indicate that the outlook on refining has weakened with sanctions on Russia lowering availability of advantage crude. So we'll see which way things go. But for now, yes, Russian crude in the overall crude basket has come down.
Okay. All right, Sonal, thanks very much for that. This is something we were discussing with Prabal Sen just a couple of days back as well, when those additional sanctions on entities like Rosneft were announced. Prabal, morning. Good to have you back. So now we have the commentary from the refiners themselves. What's your read-through? And for instance, for IOC, look at this mega margin they've reported, $10.70 to a barrel in the context of lower Russian crude in the mix. So what's going on, and are these margins sustainable?
Honestly, they have an analyst call today, so we would obviously want to interact with the management a bit more to understand where the margin beat has come from. It's definitely come ahead of what we were looking at. And I think what's showing on the screen, it's ahead of the poll as well. We were broadly near consensus at between $6.5 to $7 a barrel. So we have to understand where one of the things that is very clear is that diesel, ATF and gasoline spreads are the ones that are actually driving the margins. If you look at the trends in Q2 and if you look at what early trends in Q3 also indicate, very clearly those spreads are much stronger than what Singapore margins would indicate, which obviously is better for Indian refiners, since these three products are more than 65% of our product slate compared to being less than 35 or 40 odd percent in the benchmark slate. So I think that's one of the reasons. Coming to Russian crude, again, the view hasn't changed. I think the data shared by Sonal was useful in the sense that if it is 20%, even if the advantage is, let's say, $3, you're talking about a 60-cent advantage in gross margins at the end of the day. So if you have to transition away and take some other crude, maybe even at $1 higher, the maximum impact you're talking about is essentially about $0.8 or so. And I think I spoke about that impact earlier when we spoke a couple of days ago. So I think in that sense, it is something that should be manageable to a certain extent. Obviously, it's not welcome that a cost increase is coming in such volatile times, but it's not something that will have a debilitating impact on profitability, let's say, given the strength in diesel product margins and, overall margin environment, at least in the near term.
Prabal, that 80 cents will translate to, good morning, translate to what?
Morning.
Is about 5 million barrels per day?
In terms of earnings impact, every $0.50 hit, if you talk about, is basically somewhere between 4.5% to 7% hit on consolidated EPS, give or take. So that is the worst case impact I think that you're looking at. As far as the OMCs is concerned, the impact on Reliance is even less. If you talk about a 20% crude transition again, and I don't know what the percentage of Russian crude is in Reliance's overall portfolio, but given that OTC itself is now around 30% only of consolidated EBITDA, and within that, then you're talking about refining being maybe about 15 to 20% out of that, then you're talking maybe the earnings impact is maybe 1.5% at best or at worst, whichever way you want to look at it.
So for OMCs, $0.50 more expensive crude
is around $0.50 more expensive crude, unless mitigated by product spreads elsewhere, is about 4 to 6% hit.
Okay.
What are the GRMs you're working with, Prabal, on the whole? Because that's moved up. So in comparison to in your estimates, what have you factored in, and how does it compare with the current GRMs? Because GRMs have suddenly become very strong, right? So where are you at?
Yes. So we are actually at a level which is about $2 lower. We are working
$2 lower.
If you look at base case numbers for us, we're still working on a range of around $6 to $8.
All right.
Obviously, the current margins are much stronger.
So there is still some kind of cushion, in case cost goes up as well, you'll not have to tinker with your earnings, because as it is, you're $2 lower than what the current GRM is at. Is that correct?
I wouldn't want to speculate on what our numbers are going to be unless we publish them. Okay. But, I just told you what the base case is versus what the
so $2 lower. We got that. Also, since you briefly mentioned about Reliance Industries, over the weekend, you went ahead and you upgraded the stock as well. Give us 2-3 factors at play, and what is the new target price? Because that one has suddenly, turned up in style for the last few trading sessions.
Yeah, I think it was, there are two or three catalysts. One is that our telecoms team published an excellent detailed note on the prospects for both Bharti as well as Jio platforms, if you know, and therefore the SOTP valuation was actually moved to an EV EBITDA valuation on par with that of Bharti by the team. So that anyways sort of, given that we rely on those numbers for overall SOTP valuation, that was one catalyst. The second catalyst is that if we see the earnings trajectory across businesses, the kind of momentum that is there in terms of the retail business, the kind of surprises that have come on the FMCG, revenue run rate and revenue momentum, and the kind of plans that they have in place for growing that business. Media business, for example, H1 numbers, and I think I mentioned this earlier, the H1 numbers for the media business itself are well ahead of what we were factoring in for the full year. And that has also driven, partly an upgrade in terms of our earnings post Q2. And that also sort of factors into our calculations. Plus the higher visibility on the new energy businesses. If you look at the kind of clarity that is now emerging and the progress that is being made on at least the first phase of plans as far as solar generation and solar manufacturing is concerned, I think if we put it all together, there is a case to be made for re-rating, which is what we believe. There's a 15% earnings CAGR in EPS that we expect over FY26 to 28. And more importantly, with the turnaround and with the sort of transitioning of geo platforms into a cash generating entity in a big way. One of our major concerns or cautiousness that used to be there with respect to FCF yields and return ratios, that also seems to be getting addressed in a limited way. So that is where we believe that valuations do deserve a little bit more of a relook, and our revised target price of around 1735 has increased by around 130 odd rupees over previous target price. That's what's driven here.
15% earnings CAGR for Reliance going up to FY28 explains your bullishness on the stock. Good conversation, Prabal. Maybe we'll have you back once all the refineries have reported to take stock of, the sustainability of these margins. Once these calls are done, like you're saying, you're waiting for the IOC call today. Thank you so much. Have a good day, and we look forward to connecting again soon. That's a word from Prabal on the oil and gas space. Very quickly, going back to the pre-open session, which is now settled to a very, very, sedate kind of a 26-point cut. That's all we are getting. The mid-cap index is flashing a little bit of green at this point in time. Let's quickly get to our 9-10 calls with our experts. Sudarshan, which stock?
It's AB Capital, buy with a stop under 305.
Okay, AB Capital. Remember, we've just seen the big block trade on AB Capital play out as well. And Mitesh, your stock?
I'll go with the buy on CDSL for targets of around 1675 to about 1680.
And AB Capital could actually be one of the stocks of the day because we had Tata Capital on its listing. You saw a lot of excitement with regard to AB Capital. Return ratio is fairly healthy as well. I recall the stock was 295, 230 when we were discussing it here on Bazaar itself. And now this large trade gets out of the way. So that could be one of the stocks to track for today's session. That said, the other one could be Sona BLW that's delivered a good set of numbers. We have Sudarshan who joins us to run us through a quick analysis on that. Sud.
So pre-opening session is indicating an uptick of more than 2% Sona BLW after company has reported earnings, and that was largely better than estimates. So two announcements, earnings better than estimate, and second, that JV that company had announced in China, that JV has been put in abeyance. But brokerages are largely positive. CLSA has an outperform call with a target of 570 per share. It says Q2 margin was 200 basis points higher than estimates, and this was higher despite BEV revenue decline and integration of lower margin of railway business. And BEV revenue declined as one of the key global EV customers continue to face challenges. But the positive parties, 3 competitors in Europe have filed for insolvency. That may lead to more orders for Sona BLW as per CLSA, and that can be very positive for the company. Nomura maintains buy call and increases target price to rupees 605 per share. It says company is delivering well in tough times, and Q2 revenue beat was led by railways and traction motor, and potential order wins from struggling auto component suppliers in EU will be key upside going forward. On the valuation front also, it's finding very attractive.
Well, keep an eye on that one as we open up in terms of trade today. We've got about a minute to go for the market open to kick in. So we'll just quickly look at the first rates and then, look at individual stocks, etc. So it's a quiet start, 25, 26 odd points lower. Is where the indicative opening is at. Maybe we just look at Keynes, etc. Keynes and Syrma and Amber. These are 3 companies, listed companies, where this, where projects have been awarded under the Electronics Manufacturing Component Scheme. So some 7 odd projects, maybe I think, have been approved, and these 3, they're not. I think in the case of Keynes, perhaps the size of investment is larger than what the markets knew. So there you go. It's a positive start, but mildly so. Nifty Bank just flitting between green and red. Small cap index is up about 0.25%. The mid cap index is up about 0.2%. And even Stevens. I mean, it's too early to look at market breadth, but for what it's worth, 1,000 up and about 700 lower. That's how we are starting out straight out of the gates. We have. It's kind of flattened out even more. We just quickly look at the Nifty heat map, how the 50 stocks are opening. and then we'll look at some of the individual movers. Indigo is on one end, and I think you've got Bharti, which is on the other end. So naturally, I guess we'll, in terms of single stocks, look at Idea, Indus, etc. as well, in continuation of what we're seeing out there as far as Bharti goes. Surabhi.
Yeah, I was just looking at, JK Tyre. It's one of the stocks from the entire earnings basket, which has shot through. We'll be speaking with the management in the next, I think, 15 minutes or so. Their margin has gone up from 11.5% to 13%. Revenues up, profits up 60%. And that stock's on a tear right now in terms of just the result reactions. But anyway, talk about the large cap screen and see what is working. Nifty's up 24 points. So what's leading it? SBI 1%, Bharti Airtel 1%. Tata Steel continues to shine through. A couple of brokers have been upgrading some of these ferrous names. And I think it was Motilal. Motilal has also upgraded Tata Steel, sounding quite optimistic. Eicher Motors is putting on about 0.5%. L&T is chipping in with a small 0.5% gain this morning. Lever, again. So it's small little incremental gains across some of these stocks that I've just named. So what is not working for the market? Interglobe Aviation for sure, it's down about 1%. Remember, crude has been sustaining at 65. So that's a bit of a sentimental issue as well that's playing out. What else? Axis Bank, ICICI Bank, HDFC Bank. All the banks are seeing some profit taking. Nothing much, just 3-4-5 rupees off the shares. But that's pretty much the red side of the screen. Other than that, it's just extremely quiet. A little bit of an undecisive kind of start to trade. 25 points up on the Nifty for now. Nigel.
Well, a few stocks that are getting hit actually. HOEC is down close to on 6%. So big hit on that one. Bata, for the time being, the pair of shoes is kept in the cupboard. You don't want to throw it out, but you may not want to keep it as well because the stock is down close to around 5.5%. So big downtick is what we're seeing on that one. PNB Housing Finance, another casualty of the morning. So these are some of the top losers this morning. However, there are positive earnings reactions. As will be said, JK Tyres, that's doing well. Sai Silks, well, that stock has already had a good run. I'll be speaking to the management in the next hour or so. So keep an eye out on that one. For the timing, those numbers look rock solid. Up and about 8% and flying high. KFIN as well is higher in today's trading session. Some positive news flow. I recall yesterday to the close of trade where we had highlighted, that there was an approved list with regard to the component manufacturing projects. And one of the stocks that were mentioned out there was Syrma. That's opened up with a solid gain of close to around 3%. So that's bounced back well. I recall this was one of the stocks that we had highlighted towards the end of trade yesterday. Cairns as well as Syrma. And Suraj Estates as well. Another rank underperformer came out with a set of numbers, I think, yesterday. And that one as well up and about, in today's trading session. So pull back from very, very depressed levels. Decent start, 16 to 20 points higher on the Nifty, but the breadth of the market is positive. 1,500 stocks advancing. Yes.
Just one more stock on the results, hits and misses. Canara Robeco AMC. I mean, look at it. Stock slammed down about 8%. Yeah. Their margins have declined over 400 basis points at a time when, overall other mutual fund businesses have been doing well. Market doesn't like that at all. So that's a sharp cut on Canara Robeco.
Absolutely. I think, naturally, Idea is in terms of sheer volumes, the number one volume traded stock. It's though up just 1.5%. And Cairns and the others. Cairns is there, number 3 in terms of volume-led gains. Mazgaon is up 2%. It's got large volumes. Indus is up 2%. I think we mentioned Sai Silk, Kalamandir, which is up 9%. NetWeb yesterday was up 3%. And it's gone up a little bit more. I mean, fell to about 3,700, back to 4,000 in 2 days. Again, has done phenomenally well. K Fintech is up 4%. So, in 10 days, stock's gone from $1,000 to about 1,200. We've got, what else? Hudson, I think, was a big, massive mover, right?
Yeah.
Closed at 900 on Friday. From 900, it closed at, 1,080. Yesterday, and it's moving up more. So 1,110 on Hudson this morning. Welspun Corp almost 900. It's up about 2.5%. Volumes yet to pick up if I go down the list, but there is more action in that sense, which we will highlight. Supreme Industries reported numbers. It's down 3%. So along with Bata, that's the other one, which is taking a bit of a knock. We've Gautam Trivedi, who's now joining us right here in our studios. He's, of course, managing partner, Napian Capital. Gautam, great to have you with us here. Good morning.
Good to be up.
Good to be back in the country as well. I guess you're traveling.
Yeah, I was out for 3 weeks to the US, both East Coast and West Coast, and I've come back with a lot of stories. So I'm happy to share some of them.
Tell us a few stories.
Have you caught the investors? Did you catch them in your bag and bring them to India?
Yes, you've seen the market going up, and you've seen them coming back. So I'm partly responsible for that. But yeah, I think overall, the view on the market out there is that the domestic economy is so robust and so strong in the United States. Whether it's hotels, restaurants, flights, they're all packed. And if you look at the absolute numbers that the S&P 500 companies are putting to work in terms of cash deployment in this year, it's $4 trillion. That's all of India's GDP in just single year. And of that, half of that is CapEx and R&D. And of the CapEx, about 27% is AI hyperscalers. So this is a number only of the top 500 listed companies. I'm not even counting the other, I guess, 4,000 companies plus the unlisted private companies. I mean, obviously, OpenAI's CapEx is not captured in this number. So that's the extent of, the absolute amount of money that's being spent. If I break that number of 4 trillion further, 1.7 trillion is actually buybacks and dividends. So this year, US shareholders / consumers will have 1.7 trillion in their bank accounts from buybacks and stock dividends. Next year's number is 4.4 trillion. So that's a 10 to 11% increase over this year. So the economy is very robust. I'm sure that message is coming out loud and clear.
But what about this whole debate around the AI bubble? What's the sense you got? I mean, are there more in the camp who believe that this is a bubble, but ride it till it lasts? Or is it actually, look at the layoffs, for instance. I mean, Amazon is a big story this morning, 30,000 people they're laying off. So, and then the cross-company deals that have been happening.
Yeah.
What's happening with the AI trade?
So the AI story is omnipresent. You could go to we went to Vermont and people were talking about AI. So it's all over. If you look at San Francisco or the Bay Area, I'd say about 80% of the billboards had some AI company advertising their product and, the use case. So, and I spoke to one specific investor who hosted a bunch of undergrad kids, about 30 kids for lunch. This is a bulge bracket firm, and they usually do that, meet students from other universities. And he asked them the following questions: how many of you use AI? Everybody put their hand up. Second question: how many of you use ChatGPT? He said about 80% put their hands up. I guess the others were using some other model. And if you look at ChatGPT, 800 million weekly users. That's 10% of the world's population. So AI is here. Is the business model broken? No. Is the valuation crazy? Yeah. Yes, it's crazy. And then, yes, a lot of people did complain about that. In fact, the question asked to me was, are there AI plays emerging in India? And in the listed, and of course, there's some in the private space, but specifically in the listed space, and we've seen NetWeb just now having a rally. But there are very few plays really at this point. So
does that come up as one of the reasons why? I mean, because everyone wants, slice this AI big boom.
Yeah.
Bubble we don't know, but boom certainly. You think that's one of the reasons why India's kind of lagged a little bit?
No, I think India's lagged not so much from the AI issue. It's more to do with the fact that the valuation's historically been expensive. So I don't think anybody's complaining about our valuation. What's amusing is that at 22, 23 times forward earnings, the US market for Americans looks very, very expensive. Here people would say, what's the big deal? It's only 22 times. It's really not that expensive, right? But when the issue is high valuation with an earnings slowdown. So you put that together, then we have a real problem.
Yeah.
So the slowdown or the selling in the last 12 months from FIs has been focused primarily because of that. If earnings come back, and that's the question everybody asks me, when are earnings going to come back? And is the revival in demand with the GST cuts, is that sustainable? And I guess we'll know the answer by the end of December as companies start announcing the numbers, or early Jan, should I say. But the fact is, the interest at this point in India, surprise, surprise, actually is very high in interest. Doesn't mean they're coming back next week, but the interest on what's going on in India is very high.
Your note is pretty interesting, Gautam, and you make a mention, and we actually would have loved to that AI billboards and AI around. I think you put some pictures there as well. I wish we could show it.
That reminds me of college time, just the turn of the millennium. the dot-coms. Well, the internet companies lasted and they're thriving today, but not all dot-coms lasted.
Well, you know, I made a analogy with when you go to Pune. 80% of the billboards are residential projects. I mean, it's like as if this city has nothing else but housing.
Housing.
No, it's actually, I was in Bangalore. It's the same thing.
Same thing,
There's
right?
property everywhere.
Property. I mean, across.
Hopefully, we'll see more AI in Bangalore.
More AI in Bangalore. You know, you write in your note that interest in China and Japan is peaking.
Yes.
That's the sense you got?
That's the sense I got. So let's make a case for India, and this is what I've come back positive, believe it or not. In spite of all that I've just told you, I've come back more positive on India than I was in the last, I guess, 12 to 18 months. First and foremost, if you look at our weightage in the MSCI, we've gone from a peak of 21% in September of last year, we're down to 15.7. We're now third highest in Asia, within the EM basket, not just Asia, so after China and now Taiwan, and we're number 3. Second is the average investor or allocator that I met is underweight India by 200 to 250 basis points. So that's obviously a huge underweight. If you look at the underperformance that we've had this year, and I'm just going to rattle out some numbers which even I didn't know until yesterday. This was the level of underperformance. Korea year to date dollar return 81%. Taiwan, China 35%. Hang Seng 30%. We're 5% dollar return. So a lot of this makes the case for India starting to look attractive. Plus, as you said rightly in my note, that interest in China and Japan clearly has peaked. You know, 2 years ago when I was in the States, a lot of investors were talking about India and Japan in the same sentence, which was fantastic. But of course, that slowed down. As earnings slowed down, that went out of the window. But I think people are now asking the question that if China's and Japan, we think, have peaked in terms of absolute equity market performance, should we be deploying money in India at this point? And will earnings come back? And will the GST cuts result in a big revival? So that's, you know, a lot is riding on the GST cuts.
Right. And I think, you know, as you said, if earnings come back with the FIs being underweight and post our underperformance, hopefully we do see a gush of money. But earnings need to pick up first. You know, Gautam, in your note, I was going through various aspects, and the chia seed pudding, you know, that's an interesting one. You know, over the weekend, my wife served me one of those, and glad she's making it at home.
Exactly.
Looking at the costing out there, oopsie daisy, I think Babe's doing well, making it at home.
No, but I think, yes, I don't know how much she's charging you for it, but...
No. It's made at home, so that's good.
Chia pudding this small, literally, and I'm on TV, so I can show the size. It's this small. It's $10 in New York City.
Whoopsie daisy.
What is this?
It's just a chia pudding, this small.
Pudding. Okay.
It's extremely good for health, Prashant. I was told on this weekend.
But you need a couple of them, you know, about $30 to actually make a real meal out of it.
And you've mentioned as well, hotel room rates as well are going skyrocket, right?
Exactly, yeah.
And okay, let's get back to another important factor for our markets, the trade deal. Our numbers not coming. I mean, we thought we would be top of the pops, maybe the first ones to get a deal. That's not happened. At least over the last month or so, some optimism is coming back. How important is that? India getting a favorable trade deal, you know, in light of this entire foreign institutional holding here in India?
That's a very good point because, well, the question I think in some sense is that has the trade deal or the lack of it impacted our foreign portfolio investors from putting more money to work in India?
Has it?
To some extent, yes. Of course, it would be a emotional positive or incremental positive for India if that were to happen and whenever that happens. But I didn't get a sense that that was holding back investors from putting more money to work in India.
Okay.
Because the fact is, we're only 80 billion in terms of total exports to the US, less than 2% of our GDP. So I don't think people really cared so much as they did for China and the US.
So the trade deal doesn't move the needle too much.
No, it brings back the annals for this.
It brings back a positivity.
It brings back sentiment, which brings me back to earnings. Because
that's right.
I was hearing you say that, and it's so true, right? We kept, saying that 22 times, 23 times, we're always an expensive market. I mean, big deal. If you have to be in India, you have to pay a premium.
That's right.
But those were the years when we could boast of 15% plus compounding growth for quarters together, right?
Yes.
Now, what did you tell investors? And they're asking you about this, right? Is earnings coming back?
Yeah.
What's the sense? I mean, not 1 quarter or two. This is a bigger issue, Gautam.
It's a bigger issue, yes, undoubtedly. And I think, but there are two things. Again, we've seen over the past 3 to 4 years, the money that's coming into the equity markets is driving the equity markets. And the money is coming into the equity markets not because of earnings growth or earnings slowdown. It's coming in spite of the earnings slowdown. So why is it still coming? Because the alternative investment avenues yield lower yields. So as a result, are you going to put money in a savings account? My HDFC Bank account is 2.5% pre-tax. A 1-year, 10-year fixed deposit is 6.5% pre-tax. I think we're doing a good job of marketing the equity markets through CNBC and the media. So people are putting money, every single day, every week into the equity markets. And the other statistic, which I may have mentioned before, is that of the 120 million unique investors in India, 5 states account for 48% of those investors. So the equity culture, which has started to spread over the past 3 to 5 years in India, which is great, has not even reached the halfway mark. We're talking of more penetration coming over the next 5 to 10 years.
Which is great, but it's also a bit of, I don't want to be a big bear here, but that's also a bit of a risk building, right? Because that equity culture will keep growing and people from tier 2, tier 3, tier 4 will keep investing. Again, if you don't have earnings, then we'll be trading with our own money, we'll be trading at 24, 25, 26, 27 times because there's so much money chasing the same earnings pool. Isn't that a concern?
That is a concern,
A lot of supply as well, right?
And a lot of supply. Thank God for that. Yeah.
Thank God there's supply, because if the supply wasn't there, then the market would be even more expensive. I mean, the secondary market. So it's good to see that there's more supply coming.
I was speaking to an investment banker just yesterday, off-camera conversations, and he was like, let's face it, at the end of the day, you've got to get the animal spirits fired up. People have to start putting money to work to create capacities, to create businesses, even if those capacities lie idle for 1 or 2 years. Till that happens, and it reminded me of what Mr. Uday Kotak said, right? I mean, if you're just about selling businesses, doing the blocks, running family offices, and then you complain earnings nahi aa raha. Can't have it both ways, right?
No, absolutely. And I think it's a good point. Gautam, in terms of, markets is, of course, all about picking individual names, right? Individual ideas. So what are you doing?
So, what we're looking at, financials are back. The good news is that you've seen a lot of M&A activity, strategic change in CEOs, restructurings. So the financial sector, and I mean the overall financial sector, not just the commercial banks, but even the NBFCs, the gold loan companies, etc., all of them are having events and triggers that are happening around them. So, that's a very exciting space to be at this point. Secondly, I think going back to AI, there will be more AI companies, much like, today there are a plethora of 15 EMS companies that are listed. 5 years ago, Indians didn't even know what EMS stood for. And now we have 15 companies. And Dixon, of course, is the poster child, but there's so many others that are doing extremely well. So I think there are emerging businesses coming, new IPOs of companies that, are very unique in different businesses, aerospace, defense. And I think AI, hopefully, we'll see more companies IPO over the next few years.
Fractal's IPO is coming.
Yeah.
And I think next month, right?
I believe so, yeah.
But some $3 billion valuation.
Yeah.
So we'll have to see.
But Gautam, since you're in the studio, you've given us a couple of themes.
Yeah.
What have you all done? If you could name a couple of, with due disclosures, what do you like? A couple of themes you like?
So
if you could name, a few names as well, will be helpful.
Sure. Our way of playing AI actually is through power.
Okay.
So, based on what you've seen over the past 12 months, power is really the need, if you want AI to succeed. So the Wall Street Journal last week had an article which said that as of the end of 2020, 2% AI hyperscalers consume 2% of the US electricity total consumption. By 2028, it's going to be 12%. We'll have a similar situation here. I don't know what the numbers here today because we have only all of 1 gigawatt of capacity. But if going by all the numbers that are stacking up, going to 9-10 gigawatts, we're gonna need a lot more power. So in our case, we played a power as a theme that's going to be sustainable for the next multi-decades. We like TD Power beyond that. Our portfolio is on our website, so no, you're not concealing anything. We like GSW Energy. We like transformers and rectifiers. So we have a bunch of these stocks, and we like Inox Wind.
All right.
IPOs, just give us your overall sense on valuations and whether it's a decent party, well-regulated party, or if it's getting a wild party. Lenskart asking for 70,000. And some of the new companies obviously don't make profits also. I mean, and you have to look at, I think it's coming at 10 times sales. There's been LG, however, on the other side, Urban Company.
But look at LG. I mean, I'm glad you brought that up because the valuation of LG India is more than the valuation of the parent. The market cap is more than the market cap of the parent. So what does that tell you? That domestic investors just don't care. They're looking for the next interesting stock, and they want to hold it for from 6 weeks to 6 months to longer. But I think that's where,
Are you comfortable with the kind of asking numbers?
Well, the fact is, Shobhi, you've got to put on a capital markets hat. We all do that when we buy and look at a stock. Yeah. When we buy the stock, the first thing we think about is how will the market appreciate this number? If it's trading at 35 times, is the market ready for 35 times? I'll give you an example. We used to own Varun Beverages for the longest time. It traded at 45 times earnings when people said, gee, this is so expensive. The market's comfortable with this number. So why are we fighting this? So, I think that's the other way to look at this.
Yeah. As long as the growth can justify it, absolutely.
Exactly, yeah.
And also one point with regard to this IPO euphoria, right? At times, since we just spoke about Urban Company, the stock is sub 150 rupees. Just post-listing, very good story, long runway. Yeah. You need to be careful at times with regard to this listing euphoria, because the stock from 200, now it's at 150 odd, so you'll get your entry point. You need to time it a little bit better, I think so.
Absolutely. Okay, Gautam, great conversation. Thank you very much. And
thanks,
as always,
seeing you guys again.
Love getting those snippets from the ground after your US trip. So thank you for joining in on that. Have a good day. Well, with that, quick glance back at the market. Where are we? Okay, 65 points higher. So the dip is getting bought. And remember, both our technical experts were exactly advocating this. Wait for the dips, and if the dips come, then buy, because the trend seems to be very much intact on the upside. So right now, we're at the morning session highs. Let's focus on a couple of stocks. Going back to Bata, has it recovered? Not really. Still down 5.5%. Not quite in step with the investors' expectations. Mangalam.
Well, there were a lot of wrong footings during this quarter for Bata. If you look at it, to take that punt forward as well, a couple of things happened. One, there was that transition from GST rates that impacted the last part of the quarter. In the middle of the quarter, we had, a disruption in one of their biggest warehouses. So that led to some sort of, impact. And more importantly, the company also looked at destocking some of their inventory at lower prices. So that impacted their overall margins. And then over and above everything else, we had a VRS that they started in one of the plants. And as a result of which, there was an exceptional loss of or exceptional expense of over 8 crore rupees. So all of that meant that right from the top line, the revenue declined by about 4%, and it wasn't on a high base either. Last year as well, the revenue was absolutely flat. And then because of the inventory markdowns and all the disruptions, etc., the EBITDA fell by about 17%. The company had to increase their marketing spends as well. And finally, the exceptional expense meant that it had a further impact on the net profit. And from over 52 crores, the net profit actually fell by 74%, all the way down to 13.8 crore rupees. The company said there were deferments of purchases, but they had a couple of green shoots. The one was that, there were signs of recovery in the festive season. So that's something that we'll obviously get a little more color on. And we had premium products like the likes of Hush Puppies, etc., doing a lot better. So could that mean that maybe the worst for Bata is over or not? That's a question that I believe that the management will have answers to. But for now, on the back of a quarter where a lot of things went wrong, the stock down 5%.
Okay, well, Mangalam, thanks very much for that. We'll take a quick commercial break here. Up next, we connect with the management of JK Tyres and Industries for their second quarter earnings, coming up in just a bit.
Welcome back. Well, keep an eye out on a few stocks in the broader markets. We have Welspun Corp. The stock is showing strength after a while. Just looked at the exchange, and later this week, they'll be reporting their numbers. So the street, it seems, are coming to terms with that. Remember, from the recent peak, it saw a sharp correction. I think 950, 960 odd, went down to around 820, 830 odd. And last two sessions, actually, it's moved up. So maybe anticipating stronger numbers on this particular name. That said, let's focus on a good result today. JK Tyre reported a healthy set of numbers. The India business has been leading the growth. The Mexican business as well delivered a steady performance. To discuss this and what's the way ahead, We're joined by Anshuman Singhania, the Managing Director at JK Tyre. Hi, Mr. Singhania. First of all, good morning and congratulations. A good showing. The street likes what you've delivered. I want to focus on the profitability aspect.
Thank you for having me on the show.
It's a pleasure, Mr. Singhania. Let's get a couple of numbers out of the way, though. The margins, that's a pleasant surprise. You've delivered close to around 13% in terms of EBITDA margins. Even your gross margins, they as well are looking quite good at around 39%. Now, we know that raw material cost has perked up a little bit. What's the sustenance in terms of both these two numbers, EBITDA margins as well as gross margins? Please go ahead.
Yeah, sure. Indeed, JK Tyre has done well. Our margins have definitely expanded based on the raw material decrease, plus our push on premiumization. Our product mix has enriched, and we have also got a lot of excellence in our operational excellence as well. So going forward, it looks like the demand is going to be steady thanks to the GST and the general sentiment which is picking up in the rural segment. And there has been an uptake in the overall automotive industry. So we are very much hoping that for the full year, going forward, H2 should be looking good.
Okay, all right. So you believe margins could sustain around these levels, in the vicinity of these levels?
Yes, margins would sustain in this level going forward.
All right. Let's focus on the larger part of your business and the India business. You've mentioned 15% volume growth in the domestic market. Could you tell us where's the strength coming from? The replacement market, the OEMs, if you could give us a brief idea in terms of demand trends?
Yeah, sure. So we did a double-digit healthy growth in our domestic market, and our products like truck radial and passenger saw very steep growth in terms of the volumes, and even the farm, even in the OE and the replacement, did exceptionally well. So we see this growth being continued, at least in the next quarters as well.
Anshuman, hi. Good morning. Great to have you on the show. Surabhi here. Can you expand on that point? Because that's really not a million, maybe $1 billion question. Whether the post-GST cut pop, this festive pop that OEMs have seen, whether this is really going to be a lasting trend for the coming many quarters. What's your sense? What are your channel checks telling you? And between the two markets, OEM demand and replacement market, for the second half of the year, what will the trends be like in both of these segments? And just break down that volume estimate. You're saying 15% volume growth. Where will it really come from?
So I think starting from the OE, in the CV market, which was very much muted, we are seeing a mid-single-digit growth coming in from there. In the passenger, we are seeing a strong single-digit or a high single-digit coming in from the passenger as well. Even in the tractor, we are seeing a good, strong single-digit to a double-digit growth coming in. So overall, the automotive industry looks healthy. So we are seeing a 7 to 8% growth in the automotive industry coming in. In terms of the replacement market is buoyant because of the GST. I believe that the dealers have flushed out a lot of inventory. So that gives room to the fresher sale. We have seen a strong number of TBR volumes grow by 22%. We've seen in our passenger line volume, which grew by about 16%. So that's all indicating a healthy double-digit strong growth. And with our new introductions of products and going into the white spaces, I'm sure we'll be able to keep up this momentum very strong.
And would it be possible for you to share roughly, if you talk about the total top line, what is the breakup between OEM and the replacement market for you across the portfolio?
So the replacement would be about 60% and 40% would be the OE.
And you would expect this ratio to continue even towards the end of the year, the 60-40?
Yes, we would continue. We see that to continue in this proportion.
Okay.
Mr. Singhania, morning. So, one question a lot of investors keep asking is this GST-led boost to demand durable across categories, cars and everything across the board? So if I were to put that to you, because you would get a sense, right, from OEMs, how they are planning, because if they're seeing demand ahead or not. I mean, how would you answer that?
No, definitely the GST has given across the board a good boost to the overall sentiments of, and hence the demand across the sector has picked up. In terms of we seeing the robustness in terms of the OE, whether it is the CV or the passenger car vehicle, which is in terms of good production numbers which are coming our way. We are the largest in the truck radial space where we are catering to the OEMs. And we see a good boost in the entry-level vehicles also coming in the car. And I think that is going to be playing out going forward in the subsequent quarters as well. So overall, we see a healthy growth which is going to be coming in from OEM. And
so November, December, I mean, this will sustain. That's my question. Or you think once again from inventory getting corrected, you'll end up in a month or two, you'll end up with a situation of excess inventory. That's the fear.
No, actually, the underlying demand has been very good. In terms of the rural demand, which is picked up, also the infrastructure push, which the government has been doing, that is leading to a lot of demand generation, especially in the trucking segment as well. And there has been a boost in terms of the cars as well. So that sentiment combined with rural sentiment, which we are seeing in the farm and the two, three-wheeler. So that is a good indicator that it is showing that it is going to be continuing going forward.
Okay, all right, Anshuman, we'll leave it on that note. Good quarter, and you're expecting it to be a good second half as well. Shareholders will definitely hope it plays out that way. Thank you so much for joining in, and all the best for the rest of the year as well. Well, from JK Tyre, which has been reacting quite positively to numbers, to Bata India, which has had a bit of a rough quarter. Stock's still down about 5%. After the company reported pretty mixed set of numbers for Q2. A lot of the major parameters are actually down as the company has been going through the GST transition. We have Gunjan Shah, Managing Director and CEO at Bata India, to walk us through some of these trends. Gunjan, thank you so much for joining in. So for the benefit of our viewers, I'm just running through the numbers again. Your top line's down by about 4%, and profits have also been slightly sluggish, if I could say. Margin is at about 18% versus almost 21% same period last year. So just tell us, is the bulk of the GST pain over? What is happening with the inventory, and what is happening with your pricing strategy? Because that threshold where the lower GST comes in is at 2,500 rupees. So, will there be a propensity, say if you had, a product at about, 2,800, will there be a tendency to now reprice it in such a way so that it gets the benefit of the lower GST? So therefore, how should we expect this transition to play out over Q3 and Q4?
Sure. Hi to your viewers. Good morning and belated Happy Diwali. It's been a quarter that's got impacted by the transition, but we were well behind it on the 22nd of September when the effect went into place. It did obviously impact trade and consumer sentiments and therefore deferment of purchases. But I think post that there has been a I think a good uptick and recovery, in which we hopefully will pan out over the next couple of quarters. From a pricing point of view, Surabhi, what we have done is we have, as was also suggested and indicated by the government, we have passed on the entire benefit. The portfolio that has got, obviously will get repriced because of this is almost about 80%, and that has already been done. So that's already in market, right? So we will basically want to ensure that we stay with the principles of passing on the price benefit to the consumers. In addition to that, because we wanted to manage and lubricate the transition and therefore clear out inventories, that did have an impact on our gross margins temporarily till about 22nd. We are hopeful that all of that should now recoup back as things stabilize post the 22nd.
So some numbers here will really help. I mean, even if let's not look at Q2 alone, let's look at first half. Mangalam's helped us with the numbers there as well. Revenue is up just 2.2%, and your first half margins are at 19.7%, just south of 20%. So let's talk full year now. By the time this year ends, all this would have normalized, right? So full year, what's the expectation for top line and margins?
Yeah. So we are hopeful, obviously, of this recovery will sustain going forward. And in fact, actually, in my view, I think GST is a structural piece and therefore should have a structural demand recovery. In addition to that, there are a few other initiatives that we have done. I think one of the largest ones has been zero-based merchandising and the refreshing of our stores. So we have already hit about 250. We plan to hit 400 by the next quarter and 800 by middle of next year. So I think that refresh is giving us significant bounce back in terms of like for like in the stores that we have done. So that plus, I think some of the collection that we have launched, I think the Victoria Ballerina collection has been a big success. We expanded to almost a full store network as well as with much larger volume and variety, and that should give us an uptick. So I think a combination of the GST structural impact, some of the store refresh that we are doing, as well as the collections and the stories that we plan to present to consumers should augur well for us going forward. From a margin perspective,
Mr. Shah, sorry, just to come in, could you, for both revenue and you characterize the environment, would you be able to put some numbers to it? H2, what kind of growth?
Nigel, but what I do foresee, obviously, is a significant amount of bounce back coming through with, obviously, the GST transition pain under the belt.
Prashant here, sir, but you don't think there is, you won't be able to sort of put some numbers on it?
Yeah,
your assessment.
I will refrain from giving you a forecast, but we are pretty positive post the 22nd from the response.
No, but can you sustain a 20% margin with the repricing? Like you just said, 80% of the portfolios had to be repriced. So can you still do 20% margin?
No, so we've done it. It's basically impacted, about 6% for pricing of products which are below 1,000, as well as about 11% for the ones that are above. And that is margin neutral. So that doesn't impact margins at all. I think this impact that we saw last quarter was largely because of the transition should bounce back.
All right. Hi, Mr. Shah. This is Nigel. Yeah, good to speak to you. Premium products as a percentage of your total sales mix, how much is it?
It's about 30%. And obviously, even last quarter, despite the transition pains, premium has done well, which is Hush Puppies, Power, Floats, etc. So that continues to have much better traction. But we are hopeful the lower end also will see much better traction now with the, the tax arbitrage coming down.
The ideal sales mix be if premium is at around 30% right now?
Yeah.
What would the ideal mix be? Where do you see that number headed?
So it'll keep on creeping up as premiumization continues in the economy and consumers as well as in our portfolio. So my sense is that this will keep adding about 2-3 percentage points every year. So it should reach in the next about couple of years, I think about 40% plus.
Can you tell us about your e-commerce sales plan as well? What is it at? Where do you see it headed? And the measures that you all are taking in?
Yeah, so e-commerce has been our fastest growing business, just like most other players, right, over the last 5 years now. Now it is low double-digit contributions to us. We've also been very conscious of making sure it is accretive in terms of profitability. So it's not been just, sell at the cost of anything. So we've been very conscious on that front. And I think we are expanding going forward. I don't see a reason why it should not be our fastest growing channel going forward. From low double-digit contribution in the next 2 or 3 years, we should be at about 20%, north of 20% contribution. So it will be a fastest growing and will drive growth for us.
Mr. Shah, just to press, without asking you to put numbers to it, but revenue growth has been low single digits. Do you see, I think margins are below pre-COVID levels. Could you give us some sense of how this is likely to shape up? Some analysts are cutting your expectations from where you are for FY26, FY27, etc. So how would you look at it?
Yeah, no, thanks, Prashant. So I think the way we are looking at it is that margins per se, I think, are a combination of both the leverage on top line as well as in terms of cost structures. I think in terms of cost structures, I feel very comfortable in the space that we are with the kind of structural corrections that we have done, including the one-time VRS that we have done even last quarter. So we've been more than happy to make sure that we invest in those cost structure corrections that we are working for the long term. So I think there we are pretty comfortable. Once the leverage on the top line comes through, the margin should bounce back.
All right, and there'll be some annual savings as well because of that VRS, right? You want to quantify it very quickly?
Absolutely. They give us paybacks within less than 3 years. So there will be, savings recurring for us perennially.
All right, the shoelaces seem to be tied and you're set for a bigger sprint in the time ahead. We wish you well, Mr. Shah. Look forward to chatting up with you. Past quarter may be a little bit softish, but you're guiding for better times ahead. So we'll track you to some of these numbers. Have a good day ahead. Well, let's move on then and let's shift focus to our special segment, Quarter Se Quarter Tak, to get you expectations from every sector. Today, Vinny is joining us. She's going to tell us what we expect from capital goods. Vinny, over to you.
Hi, good morning. So in terms of capital goods, this time we're expecting a mixed quarter coming for the capital good players in September quarter, ended 30th September. Now, a robust order book, that is what we're going to be starting with. That will start converting into higher revenues, and selective companies will see margin expansions. Talking about the order inflows now, in terms of order inflows, they're expected to see a bit of a drive coming in, and that will be something that will be driving the narrative of Q2 FY26. CG Power, that is expected to stand out in terms of order inflows, 27% growth on a year-on-year basis, and closely followed by Hitachi Energy, 17.8% YOY growth is what one is expecting there. Siemens is expected to deliver an 11% increase in terms of order inflows. Now, looking at ABB, they're expected to see a steady progress as well, while Thermax, that's where we could see a bit of a moderation coming in terms of order inflows, a decline of 11%. BHEL, a decline of 29% is expected in this quarter, maybe because of the legacy headwinds they're facing in terms of the orders. Now, other than that, when you talk about revenues, revenue conversion is expected to be good, and the backlog of the order book that is there, that will be something that will be supporting the overall revenue growth for the companies. Now, broad-based growth is what we're expecting across all the capital good players. CG Power is going to be taking the top spot with 36% growth expected there. And then moving on, BHEL and Hitachi Energy are 19 to 20% growth is what we're expecting there. Now, coming to Cummins, ABB as well as Siemens and Thermax, that will be providing some bit of a mid-single digit to high single-digit growth is what we're expecting this time from these companies. Shifting focus to the margins. Now, that's a very divided story among all these companies. Hitachi is expected to see a very good margin expansion, 500 basis point. And then following, obviously, CG Power, Cummins, Siemens, all of them are seeing 90 to 60 basis points, somewhere in that range is the expansion expected there. But what is not expected to do well, ABB, Thermax, BHEL, in terms of margins, they are expected to see a compression coming in this time. Commodity prices and some of the legacy project issues for BHEL is one concern that comes in, especially over there. Now, overall, just summing it up, Q2 FY26 expected to be a mixed quarter supported by strong order book backlogs, broad cost rationalization that will support the margins, moderating commodity inflation is supposed to support the margins as well. Execution, that is something that everyone will be keeping an eye out on. Private capex story, where is that headed? As well as in terms of prolonged monsoons, has that impacted the EPC side activities? That will be key to watch out for. Valuation surely have moderated from those peak levels, and that is indicating that slowing order inflows that one has seen coming in. Capex spending reduction over there as well. So keep an eye out on that. Only Hitachi Energy as well as CG Power are seeing some of those premium valuations, but they've come off the peak as well.
Okay, all right. Thank you very much for that, Vinny. That's a comprehensive wrap, and it sets us up for our conversation with Harshit Kapadia, Vice President, Industrial Defense, Railways and Consumer Electrical Space, as well as Durables. It tracks a whole bunch of these capex-intensive companies and stocks at Elara. Harshit, thank you so much for joining in. So let's start with the big boys from the capital goods space. Let's get your highlights and trends. Purely in terms of good execution, a pickup in growth. Which are the companies that will perhaps shine in Q2 and going forward in H2 as well?
So companies which will see a very strong growth are mainly power equipment related companies because they have a very strong order book and largely driven by government as well as the power capex which is ongoing. That would mean companies like Siemens Energy, Hitachi Energy, GT&D, Quality Power, power industries, so cable and wire companies. These are some segments and companies which will see a very strong growth. Partly we have seen, KEI and Polycab reporting their numbers, which has been in the high double digits as far as volumes are concerned.
Okay, so some of the power equipment makers would be in double digits. Got that point. And what about the margin profile? I mean, are you expecting any significant changes in Q2 or Q3?
So as far as Q2 is concerned, we think margins for at least the equipment companies, the power equipment companies should be better. Though going forward, that is in H2, we are expecting competitive intensity to increase, and especially we are hearing Chinese competition is also slowly increasing in some of these segments, which is something which we'll be watching out for very keenly. Hence, H2, there could be some pressure. But given that revenue growth momentum would be there, assuming that raw material stability is there, margins should be in the range of around 14 to 15% for most of the names.
That's interesting. Chinese competition in which segments and what kind of, what part of the power chain that you're anticipating in H2?
Mainly on the power equipment side, that is from high, medium voltage, and partly some of the HVDC projects as well. So there has been some rise in competition.
Okay. The good thing is, from an investor perspective, Harshit, that these stocks are now, they're a little off the peak. They were all quoting at 90 times, 100 times forward earnings, right? At the peak of the whole capex bull market. How do you find the valuations now? Where is the risk reward the most favorable? And what are your top picks?
So valuations are still high. It's not very high, given that the order inflow momentum has been a bit on the weaker side, except for power. There has not been much growth as far as capex is concerned, especially the private sector capex. So we would still expect some moderation to happen as far as valuations are concerned. Though there has been some activity happening on the transmission side. A week back, there was a report on the hydropower transmission capex. They are looking at close to around 2 lakh crores of transmission capex. Apart from that, the overall renewable transmission capex is looking at close to around 9 lakh crores. So we have a decent pipeline as far as transmission is concerned. So EPC is one segment which will be very positive about. Apart from that, on the power equipment side as well. So within this, what we like is Case International. We like Siemens Energy. We like Hitachi Energy. And KEI Industries. This is something that we like. Something that we don't cover and we like is Elecon Engineering, Quality Power, and Apar Industries.
Okay, so you like players on the EPC side playing the transmission story. Nothing from the bulge bracket big MNC power equipment makers themselves, the Siemens and the ABBs of the world?
So if you look at over last 1 year, a lot of these companies have transitioned away from the power equipment to non-power equipment because Hitachi, ABB got divided into Hitachi and Siemens got demerged with Siemens Energy. So large part of the portfolio for ABB India as well as for Siemens India is more towards private capex. The trigger which could be there for Siemens could be on the mobility side. There is one large tender which is coming for the local trains, which is in Mumbai. They want to completely air condition it. That is a big tender which is going to come out probably in Q3 end is when we expect. So that could be a trigger for Siemens India. Apart from that, private side, it's a bit on a slower side at this point in time.
Okay, all right. And that's going to be an interesting one, yeah. I mean, fully air-conditioned Mumbai locals, definitely something to watch out for. It's going to be a big story overall. Thank you, Harshit, for flagging off all that we need to watch as we get into Q2 earnings with these companies on the capital goods side. Thanks for joining in. You have a good day. Well, we'll take a break on that note. On the other side, Manisha with the latest commodity market action.
Welcome back. We've got markets in focus. Nifty is down about, 60, 65 points. So 25,900 or so is where we are at. OpenAI, some announcement at the bottom of the screen. We should have it back up. Look at the turn that we've seen, by the way, as far as the index is concerned. Maybe just look at the Nifty Bank before we go any further. There as well, there is a sharp sell-off which has happened. I mean, the high was made for both the Nifty and the Nifty Bank at about 935. And from there, it's been a very, very sharp reversal, which we have seen. Small cap index, I think, has also seen a sharp reversal. And I think something similar should be the case for the Nifty mid cap index as well. Yeah, all similar kind of price patterns. A strong start, open higher at about 930.35. There has been a turn in that sense, which has happened. Well, what's the commodity sort of story this morning? Precious metals are seeing a bit of a pullback. We touched upon oil earlier. Manisha, which one is it? What are you tracking?
Well, I'm looking at precious metals, Prashant, at one point in time, it was all about new all-time highs. But in the last couple of weeks now, we're looking at profit taking. If anything, if the overnight is anything to go by the way, we've seen a 3 and a 3.5% of decline come in for gold and silver, both of these. And with this, we're now trading at 2 to 3 week lows for these. Last 1 week for the precious metals also has turned into negative, and that has pulled a month-on-month chart also in the red when it comes to gold and silver. I mean, with the wave that we've seen most of 2025, this is a new chart that we are looking at. But when you look at this year until now, it clearly has been on the positive side even now. So you have gold, which is still 52% higher, and silver with 62% of gains stands tall. I just want to take one thing away from that chart, and that really is about the silver prices there. So clearly, gold is now trading below $4,000 an ounce. We've seen 43.81 as an all-time high, and from that 4,000 important psychological level has been given away. We've seen 39.60 as a low as well in the New York session yesterday, and that's pretty much that we have seen come in for silver as well. Should get that chart on your screens as well, because for silver, 54.5 was an all-time high, and from those kind of levels, we've seen silver prices decline to around below 48 as well. 3.5% of a decline overnight markets. That would mean a lower circuit for the Indian markets, and that's exactly what we saw on MCX yesterday. Today morning, we haven't seen that trade open yet. MCX did say that they'll start at 9:30 and then 9:45 and then 10, but we haven't seen trade start yet. And there are some reports suggesting that it would be by 10:30 or 10:45 that MCX perhaps could be trading therein yet again. Take a look at what really seems to be happening into the markets, especially when it comes to precious metal right now. One, it is pure profit taking. The markets were overheated, overbought from the beginning of September itself, and some correction is what the markets were perhaps waiting, watching out for, and is what you're looking at right now. And then it also is about the US and China closing to a major trade agreement, perhaps, is what the markets are reading in. The US president is meeting Japan premier today. There are more tariff agreements happening, and that has led to that safe haven buying coming out from the market. And we've seen risk appetite money go back in case of equities there. Strong withdrawals from the gold-backed ETFs also is weighing onto the space. And then the expectation that the US Fed meeting, when that happens by this weekend, you could be looking at 25 basis point of a rate cut coming in yet again. That is something that the street has already factored in, by the way. Come to Indian markets then, and much of that premium that we were talking about in case of gold and silver all seems to have gone away. But the good thing that has happened is that with this kind of a profit taking that we have seen on the street, the festive demand has come in on the stronger side there. Indian demand also has been higher for investment. So during the Dhanteras Diwali week, people tell us that there was more bar and coin sale rather than jewelry. So clearly, investment is what we saw happen there. Also, when you look at the Indian imports itself for the month of August, were at 10-month highs. The ETF buying has been record high for the month of September. So buying in that sense also has been quite strong. And the markets really are reading into this decline in case of gold prices as temporary, as consolidation, and a longer period consolidation perhaps could take prices higher yet again. That's exactly what most banks and brokerages are still putting forth. So you have JP Morgan telling us that they still expect the prices to be above $5,000 an ounce in next year. CPM Group talks about 4,500 in this year itself. And 5,000 is a level that various banks and brokerages have talked about, including Metal Focus, Citi, Bank of America, etc. You have Ed Yardeni also talking about 5,000 rather. And Metal Focus on silver believes that while we might be trading below $50 an ounce right now, but next year end could be $60. So consolidation, well, yes. Correction, yes. Profit-taking, yes. But long-term, still bullish.
All right, Manisha, thank you very much for that. By the way, talking about commodities, look at the dominant commodity exchange, right? MCX trading yet to begin. And there was another alert which came up. So third time in 4 months. I mean, how can it be that this is, basic trading which is yet to begin. They're not being able to. And at the moment, we don't have further information from the exchange. We're trying to connect with them and maybe ask them to join us in the air as well to ask them what really is going on. On that note, let's just take a quick commercial break here. On the other side, it's our segments, The Economy, Lata in conversation with Samir and Chakrabarti of Citi, Harish Damodaran of the Indian Express on the strength of rural demand after the just ended Kharif season.